We start off with two monster moves in retail. Check out shares of Ralph Lauren and Under Armour, both soaring after blowing past earnings estimates for the latest quarter. The companies both also raising revenue guidance for the year. The bullish outlook comes as America seems to be on a shopping spree. A new report from the New York Fed showing consumers are taking on debt at the fastest pace in more than a decade. Household debt surging by $313 billion in Q2. All this as we count down to earnings reports from the big retailers, Walmart, Target, and more, all coming up in the next few weeks. So as retail ramps up, is now the time to bet on the great American consumer? Tim.
You know, I'm not sure. I think it's a better time to bet on the banks. And I think the retail consumer following through after a pandemic with a lot of money in the bank for the first time. So even though some of these household income numbers have never been higher, and I believe those numbers are right. The last 3 months, you saw household debt increase the most in 14 years. We're almost 15 trillion in debt. 75% of that is mortgage debt. And so part of this is, does the consumer have more ammunition, and are they finally getting? Look, the Fed wanted this, right? Mm-hmm. They wanted banks to lend. They wanted the consumer to be out there, and they are doing it. So I think right now it's very positive. I think, you know, you heard from Under Armour, you heard from Ralph Lauren. Under Armour's story is one. First of all, I think this has been a turnaround story, a broken company, major management changes, 2 or 3 years into a turnaround, seeing the tailwind of also higher margins. They talked about on the closing bell how some of their sourcing is better than some of their competitors. They're in a good spot, et cetera, et cetera. I think there's a lot of great news priced into Under Armour. I think there's a lot of great news priced into Ralph Lauren. I think a lot of these discretionary and some of these apparel brands are places where we priced in the consumer coming back. I think now that we're back to normalized earnings and we're looking at the 2-year stack, that seems to be one of the common themes we've been talking about during earnings. It's to me, I think there's a lot of great news priced in here. I love banks here, and we can talk about that in a second. I just, you know, to me, today is not a story necessarily to go out and buy some of these retail names. It's a story to actually go out and buy the recovery.
That 2-year number, by the way, I mean, that's comparison to pre-COVID levels, because that's a real that's the baseline, right? Not during the pandemic. In terms of Ralph Lauren, this is a continuation of the luxury story that we've been seeing play out. So this could be a case of some consumers are doing really well, others may not be.
Yeah, you know, and that debt stat that you just threw out, I think it was really interesting. Liz Saunders of Schwab had a tweet this morning about personal savings rate back to those February 2020 levels. And I think when you consider that with the rolling off of a lot of fiscal stimulus and then these eviction moratoriums and a lot of that, there's a chart right there. You see we're back at those levels. So you're starting to see, you know, some of those high-end brands that have been doing better over the course of the recovery over the last 6 to 9 months or so. What I think is really interesting with the Delta variant here and some of the restrictions that might come on and some of the opportunities to spend some of that money abating a little bit, I think you maybe want to go back to like a Walmart. We were talking about it on Friday. Costco and Target closed near all-time highs. Walmart is unchanged.
It's struggling.
Yeah, no, it's unchanged on the year, but the chart looks really good, actually. And we mentioned this. Our friend Danny Moses highlighted it to me last week. It really looks ready for a bit of a breakout. And when you look at Target and Costco on just the runaway breakouts that they are on, Walmart reporting on the 17th, it could play a little catch-up.
So back to the bunker stocks
maybe
is basically what you're saying. I mean, Pete Najarian, I want to bring you in. You tend to be a little bit more optimistic in terms of your outlook. Do you think it's back to bunker, or do you think it's bet on the consumer getting out there?
I think it's okay to bet on the consumer. I mean, clearly, when any of us have traveled, if you guys are traveling as much as I am, those planes are all full. You go into grocery stores, you go into any store, not just grocery stores, but you go into stores and it's bustling again. So that's what we're seeing here. And I think that the consumer feels stronger, and that's why those numbers look very similar. I think Dan was mentioning February 2020. When you look at what was going on then, and then obviously what we had to go through and where we're back to now, it seems like the comfort level is there. And when you look at the volatility index, we cannot sustain over 20, Mel. We popped over 20 today. We were there for minutes. And then before we know it, we closed back down in the 18s. And it's just amazing to me how quickly we actually just flipped. And that's kind of what the markets are showing us right now. I think the consumer is strong. When we've heard so far through the earnings season thus far, we've heard some really, really stunning numbers. The Under Armour numbers were absolutely extraordinary when you look at the percentage gains that they were getting there. Absolutely unbelievable. And I think when we do hear from those like Target and Walmart and obviously some of those in that big box sort of world, I think those numbers are going to continue to be strong. The one thing I would caution, Dan, I think you mentioned Walmart over Target. I look at Target, it still trades multiple-wise really, really inexpensive, despite the fact that the stock has absolutely sprinted to the upside and it's pushing right up against all-time highs right now. I think this is a stock that's bound to go to 300.
Yeah. Grasso?
Yeah, so we touched on it last week with luxury brands. I think the luxury brands are okay. Capri looks like it's still breaking out. I told you I thought that it was a double or a triple even from these levels right now. Ralph Lauren, oddly enough, is back to that pre-pandemic level. Sold off from 145. So I agree with Tim. I don't know if you should really rush in and buy these levels right here. But if Ralph Lauren holds 125, it's going up another $20. Wait a couple of days, see if that happens. Having said that, when I look at Royal Caribbean, I switch gears. Tim liked the banks. I like these names that have pre-pandemic level bookings. RCL down 47% from pre-pandemic. Norwegian Cruise Line down 60% from pre-pandemic. Delta down 38%. All of them, what do they have in common? They are busting out in bookings way above where it was pre-pandemic. So for me, look for those bargain basement prices. There's been money thrown at the retail space. People who lived through this 100-year pandemic basically want to get out there and spend money. I think we're still okay in the market and in retail.
I mean, there are plenty of ways to spend money, and it doesn't have to just be on a sweater or a pair of shoes.
Although, I mean, you know, Dan loves a good sweater.
And you love a good vest. I'm sure you're restocking your vest collection as we speak.
You have to.
In order to get out there.
We talk about inflation. We spent a lot of time talking about inflation in the last 6 months. No one benefits from inflation more than places like Walmart. Believe it or not, it's actually, inflation is good for them. So in terms of ticket sizes, in terms of their ability to pass it on to the consumer, and this is what you're hearing from all of these retailers, though. They have the ability to pass it on to the consumer. The consumer right now is flush with cash, and they're kind of looking the other way, and I think they will do this for some time. But again, back to the banks, what you heard out of banks in this earnings season was that their credit metrics are improving. And I realize when you hear a number like household loan, household debt, is at highs we haven't seen, and certainly growing faster than it hasn't since the last time we were on the verge of a financial crisis. Effectively, 2007 is when people are linking some of these numbers back to. You do have a case where certainly banks are in a very different place. The credit profile, banks are still holding back credit reserves from early in the pandemic that I think that they can drop on top of you the next couple quarters and give that back, especially with some of the the things that they've learned from the regulators.
Listen, we're talking about banks, we're talking about credit. I mean, we got to talk about interest rates right here. Like, look at the 10-year U.S. Treasury yield at 1.17. Yeah. It made a high of 1.77, right, earlier this year, I think back in March or so. So I guess my point is when I see these debt levels going up like this, and we know sovereign debt levels are up massively, we know that a lot of municipalities have these massive holes. What if rates were to go up precipitously in a short period of time? And we literally saw it from last year, early in the year, from 1% to 1.8%, and people were saying it was going to 2.5% or something like that. I think that's why you need to be concerned about debt levels, about leverage, and the velocity that rates could move if things were to start to change, especially if you guys were really worried about inflation, if that thing were to kind of come back into the, I guess, the front view mirror or something like that. So to me, I guess you got to really think about this stuff because it's all happening at a time, again, when we're starting to see a lot of fiscal roll off.
But are we worried about inflation right now? I mean, the bond market does not seem to be worried about inflation when you take a look at the break-even rates for 5, 7,
well, listen, I'll tell you this, Mel, if you look at the crude chart, the lumber chart, the copper chart, they're all breaking down of the 1 year, uptrends that they've been in. So again, it doesn't seem like too many investors are particularly worried about it, but we've seen rate moves that have gone counter to what the consensus has thought, and that's actually been a really tough trade to be on the other side of it.
Yeah, Pete, how would you position? I mean, is inflation, I don't know, a glint in your eye when it comes to thinking about the economy?
Well, I think it's certainly something that we all are keeping a very close eye on. I mean, I think it's very important, and labor obviously is one of the biggest. I mean, that consistently is something we've heard about throughout earnings. Consistently has been that commentary about trying to find labor and trying to pay, and that area is the area that's been hanging on pretty well. So yes, we've had a bit of a pullback in some of those others that Dan was mentioning, but I think the reality is, Mel, the inflation that's most concerning to me has to do with wage inflation. And that is something that I think many different companies throughout all different sectors is having to deal with. And that's going to be something that I think we have to deal with going forward for at least the next year or more. And that's something that we obviously have to keep track of. Going back to banks for just 1 minute, I would say this. I think the banks, you have to decide which banks, because there is so much differentiation these days in these banks and where they are. And when you look at the rates and all the rest of it, I think it's very important to understand what are the multiples? What is the price to book? That's something we've been using for a very long time. Some of them are more than 2 to 1. Others are much less. So I think there's a lot of different ways to look at this, including the specific financials that have exposure, for instance, to the credit card space, like a Capital One. I think there's all kinds of different financials. And I think when we just say banks, I just sometimes wonder, does the common folks at home understand what that really means? So I think we just have to clarify what names we're talking about.